A new, far more systemic threat was accelerating through the markets, one that threatened to consume the entire interconnected web of global finance. This visualization shows the weight of their financial footprint. With 76 million customers and a balance sheet holding $1 trillion in assets, AIG was woven into the lives of people and businesses on every continent. This network map illustrates the dependency. Wall Street titans, including Goldman Sachs, Merrill Lynch, Deutsche Bank, and Barclays, relied on AIG's insurance contracts to hedge their most significant trades and maintain their solvency. If the AIG node failed, the insurance contracts these banks held would become worthless. Without those guarantees to balance their books, these dependent banks would instantly fall below their required capital levels, rendering them insolvent. AIG provided the load-bearing structural foundation for the entire market. Its failure meant the total collapse of the private financial architecture holding up Wall Street. The government was forced to ransom a private corporation, using billions of dollars from the very people that corporation had endangered. Vacuum. Without Greenberg's obsessive oversight, the structural discipline of the company dissolved, leaving this massive, highly rated institution entirely vulnerable to internal exploitation. A bank holding mortgages pays AIG a premium. AIG promises to cover losses if those mortgages default. Regulators were legally barred from overseeing these swaps. Bypassing scrutiny, AIG collected massive premiums, taking on $79 billion in risk while holding zero capital reserves. The most catastrophic financial failure in history resulted in one of the most profitable investments the U.S. government has ever made. This tiny circle of traders had spent years building positions with enough leverage to threaten the stability of the entire global financial system. On the morning of September 16, 2008, the world was still reeling from the collapse of Lehman Brothers. That single bankruptcy, finalized just 24 hours earlier, had already pushed the global financial system to the brink. But inside Washington, D.C., officials were realizing that the Lehman bankruptcy was only the first domino. A new, far more systemic threat was accelerating through the markets, one that threatened to consume the entire interconnected web of global finance. This was AIG, the American International Group. It was the world's largest insurance company, a massive conglomerate that provided the underlying security for the global economy. An insurance company failure represents a higher tier of risk than an investment bank. If AIG went under, it wouldn't just lose its own money, it would erase the guarantees it had sold to every other institution, leaving the entire system exposed and defenseless. The scale of AIG's operations made it a pillar of the global community. It operated across 130 countries with a massive workforce of 116,000 employees. This visualization shows the weight of their financial footprint. With 76 million customers and a balance sheet holding $1 trillion in assets, AIG was woven into the lives of people and businesses on every continent. AIG's core business was acting as the ultimate guarantor. Major banks, pension funds, and massive investment firms paid AIG to take their risk, effectively making the company the final backstop for America's most critical financial assets. Because so many institutions used these AIG guarantees to meet their own regulatory and capital requirements, the company had become the safety net for the global economy. If that net was removed, the fundamental mechanics of financial security would vanish. This network map illustrates the dependency. Wall Street titans, including Goldman Sachs, Merrill Lynch, Deutsche Bank, and Barclays, relied on AIG's insurance contracts to hedge their most significant trades and maintain their solvency. If the AIG node failed, the insurance contracts these banks held would become worthless. Without those guarantees to balance their books, these dependent banks would instantly fall below their required capital levels, rendering them insolvent. This abstract risk had a direct physical impact on the American economy. The sudden erasure of these guarantees threatened to freeze the credit markets that allow businesses to operate and families to access their money. AIG provided the load-bearing structural foundation for the entire market. Its failure meant the total collapse of the private financial architecture holding up Wall Street. The situation provoked an unprecedented level of anger from the head of the Federal Reserve. Chairman Ben Bernanke later told Congress that out of all the events of the crisis, the AIG situation made him the most angry. Treasury Secretary Hank Paulson offered an even bleaker assessment. He confirmed that allowing AIG to fail would have been catastrophic for both the American and the global economy. To prevent that collapse, the Federal Reserve took an emergency step. They authorized $85 billion of taxpayer money to stabilize the company. That initial payment was only the beginning. As the chart shows, the emergency funding eventually ballooned to $182 billion, the largest corporate bailout in the history of the United States. The public was placed in an impossible position. To save the global financial system from total failure, the government was forced to ransom a private corporation using billions of dollars from the very people that corporation had endangered. 6 months after receiving the bailout, AIG made a move that shocked the country. The company authorized $165 million in bonuses. These payouts were distributed to the employees within the financial products division, the exact group responsible for the high-risk bets that nearly destroyed the company and the global economy. President Obama condemned the decision, stating that the corporation had reached this level of distress through its own recklessness and greed. The public fury was immediate. Americans who had just funded the company's survival watched as the architects of the crisis were rewarded with millions in taxpayer-subsidized bonuses. The focus of this anger centered on Joe Cassano, the head of that disastrous division. His role in the collapse led journalist Matt Taibbi to call him the patient zero of the global economic meltdown. AIG was in the business of safety. The world trusted them to insure against disaster, but instead, they used their position to place the most dangerous, unhedged bet in history, leaving the rest of the world to pay the price. In 1919, an American entrepreneur named Cornelius van der Star opened a small insurance business in Shanghai. Over the next several decades, that single office expanded across Asia and eventually the globe. By 1968, control passed to Hank Greenberg, a decorated World War II veteran who had landed on the beaches of Normandy. Greenberg brought strict military-style discipline to the boardroom, aggressively building AIG into the largest insurance company in history. At its peak, AIG operated in 130 countries and insured 76 million customers. They held a flawless AAA credit rating from the major agencies, meaning the company was viewed as the safest financial institution on Earth. But in 2005, a massive accounting scandal broke. Facing fraud and bid-rigging charges, AIG settled with the Department of Justice and the SEC for $1.6 billion, and Greenberg was forced to resign. His departure created an immediate leadership vacuum. Without Greenberg's obsessive oversight, the structural discipline of the company dissolved, leaving this massive, highly rated institution entirely vulnerable to internal exploitation. That exploitation began in a tiny office in London. AIG Financial Products, or AIGFP, was a small unit created by defectors from Drexel Burnham Lambert, an infamous investment bank that recently collapsed. Their business model was simple. They would invent and sell complex new financial products, using AIG's pristine AAA credit rating to guarantee the deals, and collect astronomical profits along the way. In 2002, a man named Joseph Cassano took control of the unit. He had no formal degree in finance, holding a political science degree instead, but he possessed a highly aggressive instinct for trading. Cassano cultivated a hostile workplace. Employees reported a culture of bullying, where anyone who questioned the risk of their trades or issued a warning was actively silenced and suppressed. Through sheer lack of corporate oversight, an unregulated rogue unit of about 30 people in London was allowed to functionally hijack the pristine reputation of a 130-country juggernaut. This animated diagram shows a credit default swap. A bank holding mortgages pays AIG a premium. AIG promises to cover losses if those mortgages default. Regulators were legally barred from overseeing these swaps. Bypassing scrutiny, AIG collected massive premiums, taking on $79 billion in risk while holding zero capital reserves. By August 2007, the housing market was showing deep cracks. Yet, on an analyst call, Cassano declared his confidence, stating he couldn't see a single scenario within any realm of reason where AIG would lose $1. Wall Street bought the swaps because they assumed the AAA rating meant AIG could never fail. In reality, AIG was selling fire insurance on a burning city, operating entirely unprotected. And they had a second time bomb waiting inside the company: securities lending. AIG would routinely borrow cash from corporate partners and funnel that safe collateral into other investments to make a quick return. The standard practice is to park that cash in low-risk, liquid assets. AIG took the cash and bought the exact same highly toxic mortgage-backed securities their London unit was already insuring. In late 2007, housing prices plummeted. Subprime borrowers defaulted en masse, and the value of those mortgage-backed securities collapsed. The Wall Street banks read their credit default swap contracts and demanded billions in cash collateral to cover the dropping asset values. AIG checked their accounts and realized they didn't have the cash to pay them. AIG had engineered its own perfect storm. They suffered billions in losses from the insurance contracts failing at the exact same moment their own investment portfolio collapsed, breaking the corporate dam completely. On September 16, 2008, facing a global economic freeze, the Federal Reserve stepped in. They authorized an immediate $85 billion emergency loan, taking a 79.9% equity stake and effectively nationalizing the company. Over the following months, the government committed further funds, bringing the total to $182 billion, cementing it as the largest corporate bailout in American history. This diagram shows where that taxpayer money actually went. The New York Fed used AIG as a pass-through entity, funneling billions out to Wall Street counterparties like Goldman Sachs and Deutsche Bank at a full 100 cents on the dollar. The Federal Reserve initially instructed AIG to keep these bank payments hidden from the public. Financial journalists eventually exposed the routing of the funds, triggering massive congressional backlash. The government intervention functioned as a backdoor subsidy. Taxpayer money was deployed to rescue Wall Street institutions from their own reckless gambling, using AIG as the shield. The ultimate insult arrived in March 2009. Kept alive purely by public funds, AIG announced $165 million in retention bonuses, specifically allocated for the very AIGFP employees who had detonated the economy. The political response was fierce. On live radio, Senator Chuck Grassley demanded the executives follow the Japanese example, take a deep bow, apologize, and then either resign or, quote, go commit suicide. President Obama publicly condemned the company, questioning how a corporation in deep financial distress due to its own recklessness and greed could justify rewarding its derivative traders with millions in extra pay. Public outrage boiled over into death threats against executives. The bailout severely scarred the American public, destroying the baseline trust citizens had in their financial regulatory system. The collapse of AIG established a dangerous, lasting precedent for the modern economy. When financial institutions create catastrophic systemic risk, the losses are strictly socialized by the public, while the profits, and the bonuses, remain fiercely privatized. After the 2008 crash, the focus shifted from trading floors to federal courtrooms. The collapse sparked a wave of unprecedented lawsuits as investors and executives scrambled to salvage what was left of their fortunes. Hank Greenberg, the founder of AIG, lost 90. In the face of a systemic crisis, justice remained a hollow victory for the people who built the machine. While the court cases played out in Washington, the actual origin of the collapse sat thousands of miles away. The narrative of the crash narrows down to a single office in London. Joe Cassano ran AIG's financial products division. Between 2000 and 2008, he earned $280 million, while his unit aggressively sold credit default swaps. Those same products eventually triggered a $61 billion quarterly loss, necessitating a $182 billion taxpayer bailout. The sheer scale of the damage prompted a criminal investigation by the Department of Justice. In 2010, the DOJ closed the investigation without filing a single charge. Because the credit default swap market was entirely unregulated, Cassano's risk models legally adhered to the industry standards of the time. Joe Cassano triggered a global meltdown while operating entirely within a legal, unregulated vacuum. As the legal dust settled, the focus shifted to the monumental task of corporate survival. AIG had to be rebuilt from the inside out to prevent a total systemic collapse. Edward Liddy took over as CEO for a symbolic salary of $1, beginning a grueling stabilization effort to repay the public debt. The recovery process was mechanical and brutal. Liddy's team began systematically extracting the toxic assets that had poisoned the company's balance sheet. To raise emergency liquidity, the company sold off its non-core businesses and global subsidiaries, rapidly shrinking its footprint to satisfy its creditors. AIG survived by ruthlessly dismantling its own empire to pay down its massive debts. By 2012, the years of restructuring reached their conclusion at the U.S. Treasury Department. The government sold its remaining stake in the company, successfully recouping the entire $182 billion bailout. This chart shows the total flow of capital during the intervention. The U.S. government didn't just get its money back, it realized a profit of $22.7 billion. By 2017, the Financial Stability Oversight Council officially ended AIG's too big to fail status. The most catastrophic financial failure in history resulted in one of the most profitable investments the U.S. government has ever made. While the government celebrated a $22 billion profit, the human cost of the freeze was already permanent. The credit crunch triggered by AIG's collapse led to millions of lost jobs and destroyed livelihoods across the globe. The true source of the collapse is found in Edward Liddy's testimony before Congress. Liddy revealed that the financial tsunamis that nearly destroyed the global economy originated with just 20 or 30 people inside that small London unit. A handful of individuals, managing one complex financial product, held enough leverage to bring the entire global economy to its knees. The system eventually recovered and even profited, but the structural reality remains. In a world of total interconnectedness, a tiny group in an unregulated room still possesses the power to break the world. In a single quarter, a company lost $61.7 billion, forcing a $182 billion taxpayer rescue. That level of financial devastation is hard to reconcile with a firm that started out with a reputation for intense discipline, opening as a modest insurance provider in Shanghai back in 1919. For decades, strict management and a highly conservative approach to risk turned that small operation into AIG, the largest and most trusted insurance company on the planet. So how does a century-old global titan, built entirely on calculating and avoiding danger, suffer the most catastrophic financial failure in history? A localized, highly destructive infection took root within a single department, eventually killing the entire host. That infection started thousands of miles away from headquarters, inside a single financial products unit based in London between 2002 and 2008. And the scale of the damage was completely disproportionate to the size of the team. We are talking about a group of just 20 to 30 individuals. They weren't writing normal insurance policies. They were focused on trading unregulated financial products, operating in the dark, far away from the usual corporate oversight. This tiny circle of traders had spent years building positions with enough leverage to threaten the stability of the entire global financial system. The mechanics of this collapse come down to 4 distinct pathologies. The first was a regulatory loophole involving a financial derivative called credit default swaps. This animation shows the mechanical difference. On the left, traditional insurance requires a company to legally lock away cash reserves in a vault to cover potential payouts. Looking at the empty space on the right, credit default swaps were totally unregulated. No legal requirement to hold any safety capital meant there was nothing in the vault. Because of that missing rule, the London team was legally allowed to conjure $79 billion in swap positions out of thin air, building a towering financial obligation with absolutely zero foundational support beneath it. The second pathology is an economic concept called moral hazard, driven by a company realizing it is simply too big to fail. AIG was so deeply integrated into the global financial system that they essentially possessed an implicit guarantee. They took increasingly reckless risks because they correctly assumed that if things went wrong, the government would be forced to rescue them rather than let the economy burn. When you combine a legal loophole that requires no cash reserves with an assumed government safety net, you create a machine perfectly designed for maximum private profit at maximum public risk. The human architect steering this machine in London was a man named Joe Cassano. Under his leadership, the third pathology took root, a toxic culture of fear. Employees reported that leadership routinely bullied them, actively silencing internal whistleblowers who tried to issue warnings about the mounting danger. Shutting down human common sense left the team relying entirely on the fourth pathology, a blind, unquestioning faith in mathematical models. Cassano notoriously claimed he could not foresee any scenario where the unit would lose even a single dollar, a statement based exclusively on what their algorithms were telling them. This line graph illustrates their fatal flaw. Their models were built entirely on past data, plotting a steady, predictable line based on historical housing markets. The algorithms lacked the variables to predict a market crash of this magnitude, so when reality drops off a cliff, the system was completely blind to it. Any institution that combines a workplace culture that silences human warnings with algorithms that cannot process unknown variables is mathematically guaranteed to self-destruct. The aftermath of that destruction left the public swallowing a deeply bitter pill. Taxpayers footed the bill for the $182 billion bailout, and AIG turned around and distributed $165 million in executive bonuses using those exact funds. As for personal consequences, Joe Cassano walked away with $280 million in earnings and faced 0 criminal charges. Meanwhile, the interconnected megabanks that had bet with AIG were fully shielded from the fallout. Institutions like Goldman Sachs received their bailout money at 100 cents on the dollar. The historical verdict on this mess comes from former Federal Reserve Chairman Ben Bernanke, who noted that this specific collapse angered him more than anything else in the entire financial crisis. To Bernanke, the AIG disaster stood out as an entirely avoidable human failure. There is a lasting lesson here. Whenever someone claims absolute certainty and tells you they cannot see a scenario where they lose, that is the exact moment you are in the greatest danger.